The economy looks strong. So, why are millions living paycheck to paycheck? The stock market is breaking records. Corporate profits are soaring. Unemployment remains relatively low. On the surface, everything looks fine, but beneath those headlines, a very different story is unfolding. Across the country, more people are taking hardship withdrawals from retirement accounts. More families are falling behind on car payments. More workers with full-time jobs are struggling to cover unexpected expenses. How can both of these realities exist at the same time? How can investors celebrate while ordinary households feel increasingly squeezed? The answer reveals one of the biggest economic contradictions of our time, and once you see it, you'll start noticing it everywhere. Two economies living side by side. For decades, people talked about the economy as if it were one thing, but today, that idea is becoming harder to defend. Because what many people call the economy is actually two very different experiences happening at the same time. One economy belongs to asset owners, people who own stocks, businesses, real estate, and other investments. The other belongs to workers and consumers who depend primarily on their paychecks. When asset prices rise, the first group benefits immediately. Their portfolios grow, their homes appreciate, their wealth expands. Meanwhile, the second group faces a different reality. Housing costs rise, insurance costs rise, food prices rise, energy bills rise, and often, wages struggle to keep pace. Both groups live in the same country. Yet increasingly, they experience completely different economies. Why record markets don't always mean prosperity. One of the biggest misconceptions in finance is assuming that a rising stock market automatically means the average household is thriving. Historically, the stock market has never been a perfect reflection of everyday life. It's a reflection of corporate earnings and investor expectations. A company can generate record profits, while many customers are under financial stress. Those two things can happen simultaneously. In fact, some businesses perform exceptionally well during periods of economic pressure. Discount retailers, low-cost service providers, used goods marketplaces, and yes, alternative lenders. When consumers become financially constrained, spending habits change. People search for cheaper options. They delay major purchases. They look for ways to bridge temporary cash shortages. And entire industries are built around serving those needs. The disappearing financial cushion. The real issue isn't necessarily that people are struggling. Economic challenges have always existed. The concern is that many households appear to have less room for error than they once did. Financial experts often refer to this as a lack of cushion. A cushion absorbs shocks, an unexpected medical bill, a car repair, a temporary reduction in work hours, a rise in utility costs. Without savings, even minor disruptions can create major financial stress. And when millions of households lose that cushion at the same time, the entire economy becomes more fragile. Not because disaster is guaranteed, but because resilience becomes limited. The hidden warning signs. Most economic headlines focus on large numbers. GDP growth, stock indexes, corporate earnings, interest rates. But some of the most important signals appear far away from Wall Street. They show up in everyday financial behavior. Are people saving more or less? Are they building emergency funds or depleting them? Are loan delinquencies rising? Are hardship withdrawals increasing? Are consumers trading down to cheaper alternatives? These signals often reveal stress long before it becomes obvious in national statistics. Think of them as pressure gauges. One gauge by itself means little. But when several begin moving in the same direction, a larger pattern starts to emerge. Why investors aren't necessarily wrong. At this point, it's easy to conclude that the market must be disconnected from reality. But that would oversimplify the situation. Investors aren't necessarily ignoring economic challenges. Many of the largest public companies generate revenue globally. Their earnings depend on far more than local consumer conditions. Technology firms, software companies, and multinational corporations operate on a scale that extends far beyond any single household's financial situation. That's why a stressed consumer and a booming stock market are not automatically contradictions. They're measuring different things. One reflects current financial pressure. The other reflects future earnings expectations. Both can be true at the same time. The real risk nobody talks about. The biggest risk isn't necessarily a recession. It's something more subtle. It's the possibility that millions of households continue operating with virtually no margin for error. When savings are healthy, people can absorb shocks. When savings are thin, small problems become large problems very quickly. A single, unexpected expense can trigger a chain reaction. Debt increases, bills get delayed. Financial stress grows, spending slows, and those individual decisions eventually affect the broader economy. The challenge is that these pressures often remain invisible until they reach a critical mass. Conclusion. So what should we take away from all of this? Not panic, not predictions, not fear, just awareness. Because the economy isn't a single number, it's millions of individual stories happening simultaneously. A record stock market doesn't guarantee widespread prosperity, and financial hardship doesn't automatically mean a crash is coming. The truth usually lives somewhere in between. That's why the smartest approach isn't trying to predict tomorrow. It's building enough financial flexibility to survive whatever tomorrow brings. Because whether the economy accelerates or slows down, one thing remains true. The people with the strongest financial buffers are usually the ones best positioned to handle either outcome. And in uncertain times, that may be the most valuable investment of all.